right, season 1, episode 2. Here we are, Tuesday, January 29th. More interesting topics here to talk about. Hope I found the first episode to be informational here. So today, one of the topics we will discuss is student loans. But before we get started here, let's everybody introduce each other, or yourselves rather.
Bill Seach.
I am Tom Christie.
Trey Reedy.
Adam Baumline.
So again, the purpose of this podcast and what we're trying to do here is so many questions and things that people don't know. And again, we're trying to shed light on this industry and help educate home buyers and equip them with far more information than what they're coming into today. Again, that said, we're going to start off with student loans. So, any of you guys want to start off with what you're seeing with student loans and how they're seeing these affect loan processes?
And first of all, all these guidelines kind of change frequently from time to time through the year and things like that. We saw it change last year. Adam actually has the paperwork over there to kind of give you the options that you can do with the student loans. So let's go take it to him and see what we got. But keep in mind, this stuff can change all the time. I mean, it's kind of
so these are basically the guidelines as of right now, and some of these have recently changed with Freddie Mac, and Fannie Mae's got an option that a lot of people may not know about. I would say that we would all agree that one of the bigger hurdles in qualifying home buyers or new home buyers is student loans. College is getting more expensive. People are borrowing loans, putting it off. They get out of school, that goes into deferment, meaning they're not making a payment for the time being. They want to buy a home. Well, depending on what type of loan program it is, the guidelines are very different in terms of what or if a payment needs to be calculated. On an FHA loan, more than likely you're going to have to use a 1% of the balance if the payment's deferred. So, if you think about that, if you've got a student loan at
$10,000 total, which is you got to factor in $100. But what if your credit report says $0?
For an FHA loan, you're required to use 1%. Actually, the greater.
And that was a change too, because the one I had, he got a letter from the student loan company saying his payment was 0, and they let us use that. That was a year and a half ago, and now it's different.
Yeah, from the FHA handbook says, regardless of the payment status, the mortgagee, which is the borrower, must use either the greater of the 1% of the outstanding balance of the loan or the monthly payment on the borrower's credit report or the actual document payment provided, which will fully amortize over the loan. So whichever is greater. So typically, that's if it's deferred, obviously there's no payment on there. That's going to be 1%.
But yet, even though it's deferred, 0 payment, for loan qualifications, we still have to factor in as if there is a payment.
Yeah.
And that's where you're coming up with that 1% to get them up. If it's $10,000 you owe, it's $100 a month that has to factor in, regardless of what your credit report says.
Yeah.
And I recently had one where there was like 10 student loans all listed, and the payments was 60, 70, 40, 30, but the customer had to get a letter and put them all together, which they were already together in one payment, but the credit report still said that they had 7 different payments. So you really had
tricky, and it's very common with. I think we've seen it a lot with nurses. We seem to, for some reason, get a lot of nurses coming out of nursing school. They're going back to school to become a nurse, and of varying levels there. But and they've got somewhat of a substantial student loan amount that's in deferment, and they're trying to get started on the right foot. And it's hard for them. Some of them, it's hard for them to buy a home because of those payments being in deferment and them needing to go FHA. If you're able to qualify for a conventional loan, then the doors open up quite a bit in terms of in terms of what you can do with Fannie Mae. So if there's a couple different ways that someone can actually qualify based upon what is happening. So a lot of times somebody will do an income-based repayment for their student loans, right? So you're just getting out of school, you're just getting started. Your income level is going to go up, but you start at a certain point. Well, the student loan companies can give you an income-based or an income-driven repayment plan. So for a conventional loan under Fannie Mae, if that is $0 in terms of what they're determining, based upon your income right now, you don't have a monthly payment, you can actually use that to qualify for the loan. So that's kind of nice because if you have a payment that says 0, you can use that.
That's if you have a low income, correct? Or lower income, I should say.
Well, it's income based. So based upon where you're at,
Right.
What your income level is.
It's them that tell, they here, let's see what this looks like. So they have to kind of, give them that information to derive that income-based payment.
Yeah, ahead of time qualifying. So that's a nice piece that opens up a little bit there with Fannie Mae. What if the loan is still in deferment, right? So you haven't started making payments yet, and you still want to buy a home. With Fannie Mae, one of the options is you can use 1% of the unpaid principal balance of the loan, or of the outstanding balance. So that's nice. That to some degree falls within kind of like with FHA, but depending on how that works, that might be an option for you. Another option that not a lot of people know about with Fannie Mae is they also have, it can be derived based upon the outstanding balance of all of the student loans that you have, and then they give you a repayment period, and you have to factor in the going interest rate, which they can actually provide you a link to.
So let's do an example. Let's say you have 5 student loans, and they're $5,000 each, so totaling $25,000. And right now, the payments are deferred for 2 years. I mean, the 2 years, no payments. Well, how would they factor that payment?
Well, if they had 25,000, then you'd have to, if it was a 1%, you'd have to use $250 a month.
Correct.
Now, you can take that $25,000 of student loans and you can amortize that over 20 years. The most recent rate that they gave, I think, was the one I just looked at today, was like 5.09%.
Now, this is just for not necessarily what your payment would be, but this is how they qualify to come up with a payment for a loan purpose. For you to buy a house, they got to at least say, hey, here's what the payment could look like. Doesn't mean that's what it would be with your student loans.
So that's only $166 versus $250.
So
in
it's a big
terms
difference.
of qualifying for a mortgage, it could be a huge difference. It could be whether or not you actually qualify for the loan. As the student loan amount gets greater, the repayment period can increase out to 30 years, and then it depends on, like I said, that average going rate at the time, which they do provide a link for lenders to look at. As of January 22nd, which was last week, it was a 5.05% was the rate that they used. So
for the student loans, that is just for us to figure out how to qualify
for what
for
we
payments.
have to use to qualify.
That brings me to a thought with the do not know factor too. If you just graduated from college and you got your first job and you have 2 pay stubs, we can use your diploma and 2 pay stubs and qualify you to buy a house. It's really not hard.
Yeah, if you're just coming out of school,
Right.
you've shown that you've been in school. You now,
A lot of people don't know that.
Yeah,
You
school
know, they
job
think they
time,
need,
yeah.
need to have 2 years of job time and all that, but the diploma kind of qualifies you.
it depends on how they're being paid too, right? So if
Yeah.
they're going to an all commission job, they're not going to be able to do that. But
Right.
if they're going hourly or salary, on the 40-hour week, then we can use that income to qualify.
And I think one of the things I don't want to forget how we circle back and people get, hey, I like this house, I'm using bank X, and hey, they've got me pre-approved for $200,000. Maybe they try to shop around and say, wow, how somebody got you pre-approved up to this dollar amount, yet they never factored in your student loans. Again, we just mentioned, as much as these things change and staying on top of it, you could have your hopes build up. Oh, I'm pre-approved. This bank said we can do this. You don't want to find out in the middle of that process that, oh, we forgot to factor in your student loan debt. These guidelines changed. Now where you stand, now you're in a position where you're really distraught because somebody didn't follow and keep up with themselves with the guidelines.
Yeah.
So if you have student loans, you've got to make sure you're asking, what are you factoring into my payment? How is that factored into my debt ratio? What process are you going along with that?
Yeah, or how are you calculating it? Because if you move over to, if we're looking at a conventional loan, now we look at a loan that's going to be ultimately sold to Freddie Mac.
Mm-hmm.
They recently made a change towards the end of last year where before that, if it was deferred, they would use 1% of the balance like Fannie Mae would, like FHA would, if it was deferred. Now you can use 0.5% of the deferred balance with them. So that's nice because that might open up some doors to have somebody qualify, number one. Number two, Fannie Mae and Freddie Mac do look at information a little bit differently. Based upon the automated underwriting systems, we have to run the information through and see what it's going to give us. Well, if we're not inputting the right information, if we're putting the wrong payment calculation in there, or somebody is, then you're not getting the right information out. So
to your point, we could put information.
That,
we could put information and get approval. Like that's non-verified. I can make the system show me an approved eligible, providing credit, of course. But hey, borrower X makes $200,000 a year, and we have $0 in student loan debt. Of course, why would you not be pre-approved for a $300,000-$400,000 house?
Yeah.
But now when you get to underwriting, verifying that, we forgot to do this, forgot to do that.
They forgot to put these payment calculations in there, and it can affect the way that somebody's approved. Now, are they looking at these things and can it change again? Of course, our guidelines change, like we said, fairly frequently. It's
you could throw out an example too when they could be deferred. Why would a student loan be deferred?
They just graduated. Maybe they went through some sort of a hard life event in the recent past, and they had to put it in deferment for a little bit. So there can be varying reasons why someone put a student loan in deferment. Sometimes, I don't want to say they forget about it, but maybe they're not factoring in, or there are sometimes we've talked to some teachers where over time it's going to be there's one of their student loans are always going to be forgiven after they've taught for X number of years. Well, we still have to factor in a quote-unquote payment for that when they're qualifying for a loan. Depending on credit score, depending on what type of loan they're doing, sometimes that box can be a little bit tighter for somebody than somebody else. That's where having better credit helps. That opens up additional options.
Sure.
For somebody to do that.
Or if you go back to graduate school, right?
There you go too. Yeah, maybe somebody goes back to graduate school. Maybe somebody's working and going to school right now. Maybe their employer's reimbursing them for the student loans. They've got student loans on their credit because it's in their name. You still got to factor that in. Whether or not you use the reimbursement, there's varying ways to qualify somebody to look at that. But
I think ultimately,
that's part of the.
If somebody's shopping for a mortgage and they tell their loan originator or whoever that person is, hey, by the way, I have student loans, they're deferred, so I'm not making any payments on it. And they tell you, oh, that's fine, we'll go ahead and factor zero in. You might want to start calling other people.
Yeah,
because you're setting up for failure and let down.
Yeah, you need to double check those things.
Ask questions.
And asking questions. And every lender is different. Some lenders have more guidelines or more overlays above and beyond this. Even in our world as mortgage brokers, there are certain lenders that will only allow certain things. Other lenders will allow, as we know, different guidelines or maybe not as restrictive on those guidelines. So it does vary, and it can vary institution to institution as to how they're looking at things or what they're doing.
You just said overlays, and that's something that just immediately like, well, what's an overlay? So just what Adam was saying there, Fannie Mae and Freddie Mac have particular guidelines, and they say, here's what we want to see. And an underwriter can say, okay, well, Fannie Mae says this, that's all we need. Now, what an overlay is, Fannie Mae says this, but a bank may say, well, in addition to that, to meet our standards, in addition to Fannie Mae's, it could be an extra hoop or hurdle or a tighter restriction to help lessen that risk on their personal books, knowing you fully meet Fannie or Freddie's guidelines with that. But that's what an overlay is. And those are, again, another great question. If you're trying to close a loan and buy a house, you don't want an extra 40 hours a week worth of homework to do just because this bank has all these additional overlays.
Yeah.
That's a huge question to ask. What kind of overlays do you have?
May or may not know. Sometimes it's not going to affect somebody, but sometimes it may. But that's not something that you want to find out 2 weeks into a 30-day purchase contract, and then you're scrambling to find another lender, and a lot of things happen in those 30 days on top of life and everything else you've got going on. It can be very stressful and very taxing on someone.
Overwhelming. There's a bunch of adjectives.
So. And something as simple as credit score, like one lender will go to 580, one will go to 550, one will go to 600, one will go to 620, and then there's some that only do 640. So,
and there are some lenders who, on the conventional side, maybe they're only set up to sell loans to Freddie Mac, or they're only set up to sell loans to Fannie Mae.
Right.
So, and that's not necessarily something that the consumer is going to know how to ask or know what to ask. So you could very well walk into an institution and they only sell to Fannie Mae, and that person you're working with only knows to do the 1%. Maybe you don't qualify at 1%. Maybe you do at 0.5%. Well, now you've just been told that you can't purchase a home, but potentially you can.
Yeah.
So
that's happened so many times.
That's a big piece. Where they've been told that they can't, but something has been calculated incorrectly. That's really where a second opinion.
Yeah, maybe not necessarily incorrectly, but within that particular parameter, it doesn't work. But on the Freddie Mac side,
to flip it.
They don't. It is what it is. It's stuck. We can't do this loan. But if we had the Freddie Mac version of this, we could get you done. But
we don't.
Again, if you don't ask these questions, you're not going to know on your biggest investment you're ever going to make.
Yeah. That's where that second opinion comes into play. And sometimes that second opinion, let's be honest, we've had people call us and they said, hey, I'm working with an agent that works with you guys a lot, and I have, for whatever reason, I have my preferred lender that I want to work with. Is this really happening? We'll tell people, and we do. Hey, listen, that's accurate. That's right. This is what you need to do. Or that's not accurate. This is really what now you should maybe have some level of elevated concern of getting whatever you're doing corrected.
Again, sooner than later.
We've had both of those come into play.
Yeah.
And that's just, sometimes these things just need to be verified so that people know that it's accurate. So
that's where a second opinion's always, even if you're you go to a bank and they give you the perfect rate and the perfect program and all that stuff, it's still a good idea to get a second opinion because
if they can't close it, it doesn't matter.
It could be 1% rate, but if you're not closing, what's that 1%
it
matter?
doesn't matter.
It's worth zero.
You qualify what you qualify for, regardless. You have to make sure that.
Yeah, and it's too easy. It's just so easy for people today just to take and type up a pre-approval. Oh, here you go, and just to throw it against the wall and stick. I know it's happened to all of us. And there's times where we look and wonder, why did this person even get a pre-approval to begin with? It should have never happened. In a matter of 60 seconds, we're figuring these things out. When other people are dragging these people across, 30 days or 2 months worth of loan process and expenses, just to inevitably tell them a day before closing, sorry, we couldn't get around this. Well, you knew that from day one, yet you still went through this process with them.
You had those loans,
Yeah, you just had one, didn't you, like that?
That was ridiculous.
And it was blatantly obvious that they should have never been given a pre-qualification letter when they did.
Right.
Yep. Oh, and then what did they do? Then they turned around and just made something up to make it look like it wasn't their fault. We didn't know this. Now a bankruptcy is supposed to be discharged for 2 years before a VA loan can get done.
Right.
If you don't, then you shouldn't be in this industry. That's a guideline that is pretty standard across the board. Not like a student loan that has changed maybe once every 6 months, it seems like.
Yeah, that can be.
So let's move on to like what we're working on now. Like anything like Tom, I think you have one that you're working on. It's a little different and outside the box. A purchase on home style renovation. You want to tell us a little bit about that?
Yeah. So the home style renovation loan. It's a great opportunity. So many people watch HGTV or you've seen Fixer Upper and 30-minute show looks great and easy, but who has that kind of money in their savings account to go and fund something like that right away? Working with a client now, they found a great property in Powell, Ohio, found a great deal on it. We're able to go and do what's called a subject to, which means an appraiser is going to come in, determine value to this property after improvements have been done. So they give them a value to that house, and these people are allowed to borrow against that future value up to a certain percentage, mind you, but everything is documented with plans of that nature. But you can renovate a loan borrowing against the house that you're trying to buy. And it's
or refinance your current home.
You can even refinance your current home and do an addition or do some sort of renovation. It's getting simpler and simpler to do this, and people are starting to figure it out that once you coordinate the contractors and the builder,
be a little more specific. What's the spread like? What are they buying it for? how much renovation is going in, like actual money wise. You know what I mean?
Well, that's case
Kinda
by
give 'em an
case.
example. Well,
So
I'm
some
talking
case
about
would
that
be-
deal. You know, give them an example, like
Well, in this case, he's getting $70,000
to fix the house.
to fix the house. So
Okay.
you know, to again, just for simple numbers, he's buying the house for $200,000. He will be borrowing $70,000 against that, so he inevitably will have a $270,000 mortgage. But once the improvements are done, that house is supposedly going to be worth up high threes to $400,000.
Oh, it's that big. Okay, that's a big spread. Yeah.
Again, that's just a right opportunity that and a great find
Great
in his
deal,
regard.
yeah.
So
and that money goes to the. It's be clear. It doesn't go. You don't get that money yourself. It has to go to a contractor with plans and
Well,
specs
sure,
and
yeah.
so forth. But that's as a protection to not only to the lender but to the borrower. You know, if you hand John contractor $70,000 and he decides to skip town,
Well,
you're in a lot of trouble. So there are draws and they have to know what the work has been done, and that's what the appraiser is basing the value off
Mhm.
of, is that very detailed bid
What's
of
gonna be done.
what exactly
Okay.
are you doing? You know, what how much square feet are you adding? You know, what type of cabinetry are you using? What type of countertops? You know, what surfaces floor? All that stuff comes into play.
Well, I bet
Because
people
that's
don't.
giving the appraiser the picture, if you will, of
Yeah.
what it's going to be able to derive that value once that work is done.
But the
This is what
average
property
the
is
average
worth.
consumer has no idea they can do this. They can find a deal like that on a rundown house and
Yeah.
have money to fix it up the way they want it.
Yeah.
You know what I mean? That's
Yeah,
something no one knows
and
about.
that is the conventional version. There is an FHA version too. Actually, two different versions: the 203K. There's
Sure.
a limited version and a full version. But so there are different options for someone to be able to do that.
It's awesome.
To be able to renovate a home.
Really
And
is.
I mean, I had one. This was a couple years ago now, but in I think it was either in Palo or Dublin, but I think it was like a $300,000 purchase, and they put $100,000 into it, and it was worth over $430,000, I think.
Wow.
So
once,
it's almost like instant
once they
equity
did
if
it,
you're
yeah.
willing to go through the renovation process to build the house to your liking and not just, well, we can touch up this after we buy it. And again, in a market like Columbus that is really hard right now to get a loan in, that could be a great option and a great opportunity. Again, just do what you want to do to your own place going forward. Something else that with that program that's great, you can even finance up to, I think, as many as 6 months of your mortgage payment into that. So
there's
that'll
no
help.
downtime. Yeah, that's a good.
That
idea.
way you're not, trying to spend money on a mortgage when you're not even living there yet while it's during the renovation process. It really helps that ease the cost of living going forward while that
it
is
6
being
months?
completed.
I can't remember if it's 3 or 6. I have to look. But
I thought it was at that
regardless,
worksheet. I
the
thought it
point
was
of that is
you can finance months,
some months
So
in
what
there
was the
where
required
we
down
have it.
payment on that one?
5%.
5%.
Yeah.
So yeah, it's
That's awesome.
Of the purchase price of the
Of the
acquisition
subject
cost
to.
plus
Yes.
the cost of the renovation. And
So
forth.
5% of 270. Is that what it was?
Yes.
If the 70% includes, there's a contingency reserve. There's some things that go into it, but basically, yeah, all that stuff, 5% of the total.
Still 5%.
It's a great option, and yeah, I mean, I wish I could talk the rate on here, but I can't. It's a much more advantageous route if that's something you're looking to do. You don't always have to go and buy a brand new MI house or Fisher home. If that's what you want, then that's obviously an option. But it's an opportunity again. Maybe buy a beaten down house in a great neighborhood that you can't build big giant seasoned trees on a brand new
Right.
lot. That's
Or you've
something.
got a family,
But
a house that your
you can build a new
grandparents
home.
owned, that's
Yeah.
still
Old,
owned.
it's just
Maybe
old.
You wanna
older.
go
Yeah.
purchase it, it's outdated.
Yeah,
Your home,
yeah.
purchased it, renovate. I mean, same thing. So there's some options there.
And that's where,
Um,
if as far as real estate investment, that's where you can really get more bang for your buck. But again, you do have some time of that renovation stage, but you're building to your spectrum. That's
Yeah, what you
that's
want.
it.
Yeah. You've got one of the special nationwide high balance ones going on right now. Talk
Yeah.
about
That's
that a little
news.
bit,
I
'cause
know
that's
that.
Yeah, this is
This is a huge deal here. This really is
It's really cool.
what
It's
separates us from everyone. I think.
it's a loan that goes above the
483, 250.
Because real quick before I back up, in the state of Ohio, there's either conventional or it's jumbo.
Right.
Now, if you look in Colorado or California, some of those higher balance, they have conventional, high balance, and jumbo. We do not have that in Ohio. So it's
Right.
either conventional or jumbo.
Right. So this particular loan is offered by one of our lenders, and it's letting me go to 90% on a $650,000 loan amount with no MI, which is unheard of. and it's kind of a conventional
But
rate.
priced as a conventional
It's
loan.
priced as a conventional
Not
loan.
jumbo.
So you don't get
So-
the jumbo rate, you get the conventional rate.
Right. So, and I hit the lock pretty good. It's like 4.625 already, and it's already locked in and everything. So, again, register that. $615,000 loan amount at 4.625%,
10%.
10% down.
10% down.
No
MI.
mortgage insurance.
No MI.
Yeah. So that's a really nice.
It really is.
That kind of loan is what typically or people are going to try to. It's years ago that would be an adjustable rate mortgage because it's a jumbo status loan. So
right.
Fannie and Freddie aren't going to be insuring those. It's going to be more of a portfolio 9 times out of 10.
I shopped it around, and everything I found has been in the sixes.
I mean, really, that would cover. We're primarily here in Central Ohio, but for the most part, that would cover a purchase almost to $1 million with 10% down, because you can go up to the high balance, the Fannie Mae high balance limit on that as the loan amount, and then have your 10% from there. So your $800,000 to $900,000 purchase that covers.
I mean, this is thousands.
Most of our market between that and a conventional loan, and you don't have to do a first loan and a second loan that's a line of credit that's more than likely going to increase because rates more than likely will go up, or having it a higher fixed rate second, at 7, 8, 9% or whatever.
Or HELOC that's adjustable, based on interest only.
Well, I even mentioned it.
Fixed in seconds. Yeah,
I mentioned it to some of the agents too, and they're like, "Really? That's really awesome." Because it really is.
I mean, we're talking just in 1 year. I mean, this is an egregious amount of money. It's absurd, but it's one thing to look at it and see it, or maybe even hold it in your hand until you actually realize that's a big difference.
Yeah.
What you spend on that mortgage over the course of a year just on a loan that size, 0.5% difference in rate is a lot of money.
Yeah,
that's why people used to do the ARMs, because it was half point in rate could be hundreds of dollars a month on the payment.
Sure, yeah. I actually priced it against a 40-year AM thing, interest only 40-year AM product out of California, and it was still $700 more a month. It was crazy.
And that was based off interest only, even not even this is a principal interest 30-year fixed.
Right, but I would never tell a guy just to make the interest.
Well, exactly. But to prove how good of a deal it is and how unique of a product that this is.
Right. So if you have a $400,000 house now and you want to upgrade your house to $600,000, well, it's not really out of the question because you can potentially get the same payment if you have MI now. I mean, think about it.
Depending on your rate and MI and stuff like that.
Yeah.
I mean, it's situational, but you can.
It could be very close. That's a really good point you make. That could be a very close payment between a $400,000, $600,000 by not having that mortgage insurance.
Right. A couple $100, right?
Yeah. Keeping the rate out of the jump.
Yeah. Yes.
So.
What else we got? We've got one closing that had a couple closings, and in fact, John had one today with a property inspection waiver. So we're able to not have to do an appraisal.
Was that cash out?
That was not cash out. That was rate and term. But we've gotten several of them on purchases. So if someone's putting 20% down, we run that loan through Fannie Mae and Freddie Mac and see if one of them will give a property inspection waiver. And sometimes one will and one won't. Depending on the data that they have. So that's nice if you don't have to get an appraisal. So on that refinance, his loan's essentially done.
8 days.
He just submitted it.
Right.
He's waiting on the mortgage payoff to come in. I mean, everything is done.
Another $500 saved there with no appraisal. So, that's, again, another step towards simplifying the process. Let you go about your daily business, and we get things done for you on the side. And you just get to move in when that day comes.
That's awesome.
Yeah. And I've got a home possible refinance right now, so rates went down with the kind of rate battle there with the two lenders, and we're able to, in her case, save her 0.5% on her mortgage. All of the closing costs are covered, and she got an appraisal reimbursement from the lender. So we just got the appraisal in today. It came in okay. So
they're going to give her money back for that appraisal.
The money that she paid, up front, she'll get back in pocket. So literally, there was no underwriting fee. She got a credit to cover the title fees. Same lender, so we're not rolling the escrow account over, but giving her the credit back internally and then set up a new escrow account. And she's getting covered for the appraisal. So she's able to, in her case, save 0.5% on her mortgage. She just bought the home last year.
That's okay. You're doing 1 year then, right?
Yeah, it just because of that program. So she was able to take advantage of that at essentially no cost when it's all said and done.
And again, this is I always, when I talk to clients, I tell them, Warren Buffett. Everybody knows that name. I mean, he did not just take money and put it into savings accounts and turn it into a millionaire. You move money around. And part of moving money around is moving an asset around which is your home. You have a 401k most likely with your job. You might invest other places, but if you own a home or you're buying a home, you will now be considered a real estate investment as well, and it should be handled as such. Adam just mentioned he just did a refinance for a client 1 year after purchasing. I'm doing a refinance for a client that we closed his loan in December of 2017. What's that leave him? 29 years and 11 months left.
Yeah, but that was one of 25 years, right?
Yeah. So he's going to go into a 25-year fix. So we eliminate 3 years, 11 months out of his mortgage payment. Oh, and by the way, his payment goes down $200 a month as well.
Yeah.
So again,
that's
the math.
Thousands of dollars of savings right there.
That's almost 4 years of just almost $2,000 of the principal and interest. You can own your house. You will always have to pay the property tax and homeowners insurance, so you never own the land. But the house can be paid off, and again, there's an asset right there that you're sitting on, something of significant value.
Just redoing the way that your loans are structured, if it makes sense.
It has to, mathematically.
The math doesn't lie. The math, it's either going to make sense or it's not. If it makes sense,
you have to have a tangible benefit from the lender. They're not going to do it.
Just don't go willy nilly and refinance anything.
No.
But those are two particular cases where
it worked there.
No cost for one.
Yeah.
And refinance and save 0.5%, and it's a brand new loan. So,
he gets to skip 2 payments too, which is about almost $10,000 of less money, and his payment goes down, and he knocked off 4 years. I mean, that's again back to the rate war that's allowing these things to happen. So, and again, it's always easy to look, and I try to use this too. You look back 5 years and coulda, shoulda, woulda's, and you look back 5 years, say, wow, 5 years from now he's going to have 25 years left if he doesn't do this. Well, with the refinance 5 years from now he's going to have 20 years left, and that's a significant difference in the balance on that home.
It could be what we looked at the other day. I think the big thing for one of the ones we were looking at was, so when they go to sell the home, now they're going to be paying the buyer's realtor fees and and their realtor commissions, and even if it's the realtor reduces or whatever happens, it's fine. But
there's still a cost.
The additional equity that was going to be gained, essentially they kind of covered those costs for themselves already down the road.
Yeah.
So if they hadn't done that, that was money. Either way, it was money that they were losing. So that was a nice way to think about it, because they're going to have to pay those things regardless to sell the home. And that was a way to kind of offset those costs and gain that equity back, which was really nice.
And you do nothing different. You're making the same payment essentially in that particular case you're talking, except more of that monthly payment is now going towards the balance to pay it down versus interest.
Getting rid of mortgage insurance or reducing mortgage insurance. Being able to get rid of mortgage insurance quicker by paying down the principal faster. Those are a lot of different things that they can do.
Yeah, you're sitting on an asset, and it should be looked at. You've got to make sure that your money is working. You work 40 hours a week, maybe more, so your money can do it too. And again, this is advice we share with people and just ideas that people take with what they want with it.
Well, and I've got a borrower that purchased a 4-unit property, FHA, a little bit over, I think it was about 2 or 3 years ago. Of course, property values in Columbus have increased dramatically. He's actually able now to move to a conventional loan, reduce mortgage insurance, and reduce his monthly payment on the loan.
And that's an investment, so I mean,
in
units.
His case, he's got it's a primary. He lives in one of the units right now, but he's got the 3 units are paying the rent.
Yeah.
So now he's able to put more of that money towards principal, pay it down faster, and now he's got an appreciating asset where, in his case, other people are paying a majority, if not all, of his mortgage for him. And now he can just contribute more toward it. It's building on it. The snowball's getting bigger as it's going downhill. So it's a really, really nice program.
It's funny. I talk to a lot of first-time home buyers, and it's no one really thinks, I just want to get a house. I don't want to rent anymore. But we start thinking about the future, and how nice would it be to have no mortgage? You're signing up for a 30-year fix. Essentially, that's to keep things affordable. Your goal is not to keep that loan for 30 years. But how do you get yourself in a position to pay that off much quicker? Ultimately, when you retire, have no mortgage payment and be debt-free. And you can set yourself up that way by paying attention to your asset and making sure that it's in the right position that it should be.
Is that
4 units?
I
didn't know you were doing that one. I remember when you got that one.
Yeah, that was definitely got done.
Weren't you told no by 3 people, or wasn't you told no 3 times and you got it done?
2 lenders did not accept the appraisal, and the third one did. So that was a big win for us as a broker to be able to.
What kind of rate come out on something like that?
You know,
A 4-unit?
for the refinance.
Yeah, is there big hits on it because it's a 4-unit?
Well, this is under Home Possible because it's a primary
So it's
residence.
so it's capped.
I don't have to use the rental income as part of. Well, in his case, I'm using the rental income, but the income matches up in that area.
Sure.
I think he's at 4.625 or 4.5%.
Wow.
On a 30-year fixed on a 4-unit because there's no adjustments with Home Possible, so it's really
Sure.
it's a huge.
This all circles back to
huge.
There's way more that goes into this than here's a 30-year fix for you, Mr. and Mrs. Buyer, or Mr. and Mrs. Refinancer. There's so much more that goes into it. You're not buying a car. This is, we do mortgage annual checkups. I mean, again, we stay on top of it and try to help stay on top of these things for everybody. And again, here's an idea. Oh, here's math to go with it as well. If it works, great.
Yeah.
But that's, again, we're here to try to just help people, but people need to know the questions to ask.
Yeah, I'd say that covers some of the stuff we've got going on this week. If you guys have questions about student loans and qualifying, or some of the programs that we talked about, or mortgage questions in general, you can definitely reach out. You can go to our website, strattonmortgage.com. Of course, we've got the info page with everybody's bio, everybody's contact information. You can apply right there with depending on who you're working with. Or give us a call and ask any questions that you have. We'd certainly be more than happy to assist in that.
Yeah, and check out our Facebook page. There's a lot of testimonials on there, and just some experience that people have had with us.
Facebook, Google.
Just being hands-on with everybody and informative. And again, whether we're working on your loan or not, if you have questions, call us. We're here to try to help. That's what we want ultimately.
Cool.
Anything else, Bill?
I'm good for this day.
Anything else?
That's right.
Awesome.
Little Bill, what do you think over there? How's this
That's
resonating?
a bear. He's sitting over there.
You're getting close here. You're a few years away from buying a house, so you should be soaking soon.
All right. Cool.
Awesome. We appreciate it.
Have a great day.
week.